Good morning, everyone. Welcome to Morning Markets, 31st of July, the last day of the month. I wonder what that will bring in terms of the market. But also, it marks 4 months, where as a team at True Potential, we've been working remotely. I think the other thing to say, you've probably seen various different locations across the house as I've tried to get the light in the right way to work for the videos, which at times is proving somewhat of a challenge. And you can see that today with the bright sunshine that we have first thing in the morning. Looking just at the things that as a team we've been discussing today, we looked at equity markets and how they performed yesterday. We saw European and the UK equity market, the FTSE 100, both off over 2% yesterday. I think some travelling and arriving, taking on board what central banks have been saying, particularly the Fed the previous day, but also the slew of company reports that we'd received yesterday, and just the market digesting those, the positives, those that have been able to continue to develop and grow their businesses through this period of challenge, and those such as the banks that have been more impacted and likely to be impacted going forward, where we saw banks taking increasingly larger provisions against their loan books, both to industrial customers but also to consumers. Interestingly, when we looked into the US equity market, what did we see there? Well, we saw a market that was relatively weak, in line with Europe and the UK as it opened. Then that equity market recovered. So over the course of the day, the S&P was down about 1.7% at its low, ended the day closing down 0.4%. And then the most growth-orientated NASDAQ market, we saw that close up on the day, up about 40 basis points. What caused some of that turnaround? I think some expectation of the results that were going to come later in the day from the technology sector, which I'll come on to discuss. But we also had US GDP reports yesterday, and also in Germany with the GDP report there. And that sort of set the tone for that negative market environment initially. In Germany, we saw GDP contracting 11.7% year on year. In the US, we get a much more dramatic number, some 34.6%. But that's because the US data is annualized. So if we look at it in isolation and think about the quarter, probably it's something more akin to 9.5% to 10% of the decline. But that's backward looking. I don't think that comes as a surprise to any of us that economic activity was very weak in the second quarter, albeit we do know that it started to recover through the latter half of the quarter, so May and June. The other thing that I probably do think weighed in markets yesterday was just the second week in a row where we saw the weekly claimant count in the US increasing. So it increased another 12,000. It was 1.43 million new unemployment claims coming into the US system last week. And just as that's been working its way through, what does that mean? Well, we've seen the ongoing claimant count remain relatively elevated over the period. So we haven't seen a major decline yet. So the ongoing claims running at close to 17 million people. And that was an increase of about 800,000 from where it had been previously. So the impact of the re-lockdown, for want of a way to describe what's happening in the US, is slowing down the pace of recovery in employment trends. And indeed, that's something that the Federal Reserve alluded to and mentioned in the press conference on Wednesday evening. I think with equity markets showing that weakness yesterday, we did see a strong performance from the sovereign bond markets in particular. And remember here, as yields fall, that means the bond price is increasing. So we saw the yield in the US 10-year fall to 0.538. So getting very close to the low level that it hit at the beginning of March in the midst of the COVID-19 storm, for want of a way to describe. And then if we look at the UK, we've seen the UK 10-year gilt yielding 8 basis points. And interestingly, if we look back across the rest of the gilt curve, every maturity up to 7 years now has a negative yield on UK gilts. That's something that I think will provide a challenge for the Bank of England to think about in the coming months. And it'll be interesting to see the language that they use around that in coming weeks. The other trend that has sustained yesterday was dollar weakness. Again, we've continued to see dollar weaken against the basket, but in particular against the euro as well. So ongoing strength for the euro, strength for sterling as well over the course of the day. And that, I think, is something to continue to monitor. The old adage, when the US catches a cold, the rest of the world catches something slightly worse. So we just need to keep mindful of that rate of decline in the US dollar over the coming weeks. I think then I just wanted to very briefly touch on something that we've discussed previously, the strength of the FANGs and their importance to the US market. We had a number of those stocks reporting last night: Facebook, Apple, Amazon, and Alphabet, or Google as it was known. Each of those produced sets of results that in the main came in above where people had been expecting them to. So continued to deliver for investors in the quarter, and some very interesting trends below that in which we can dig into in later editions of Morning Markets. I'll leave it there for today, but please look out for our weekly commentary that'll come out this afternoon, and join us again next week. Many thanks.